Thanks everyone for being here, and thank you Josh and Dennis for doing this fireside. As Scott said, this one's going to be open, fun. You have two incredible operators turned investors, turned operators, and continuing to be on both sides of the table, and the perspective that they bring on both the operator and investor functions and the market and the conditions that we're in at large are incredible. I'm going to ask a couple questions that I've been dying to ask both of them in a public setting, and so we'll see how that goes. And then after that, we are going to pass the mic around. Any questions that you have for them, open it up, let it rip. I'm just going to sit up here and cross my legs and have a cocktail like all of you. So, start it out. Why don't you guys introduce yourselves for the audience, and we'll go from there.
Okay. Dennis McWilliams, partner at Santè Ventures. Met many of you, although it is hard to see from up here with the lights. So, but I believe I have met with most of you out there in the audience. At least that's what it feels like. But I'm a partner at Santè Ventures. We're early stage life science investors. My personal background, I've been an operator most of my career. Started in the early 90s doing biotech and tissue regeneration technologies. In the mid-2000s, I pivoted and started a company called Apollo Endosurgery, raised angel money, raised seed rounds, raised venture dollars, raised debt dollars, scrapped it together like you guys did, and eventually Apollo actually did fine, and then made the transition to Santè a few years back. So I live in Austin, Texas.
I'm Josh DeFonzo. I, too, am primarily an operator. I've been in the medical technology field since 2003, spanning everything from orthopedics and implants to surgical endoscopy, which is how I met Dennis, 15 years ago or something like this now? Was at Auris Health, and one of the primary investors there was a group called Lux Capital Management. They were early investors. I led product strategy and operations for that company. That company was acquired by Johnson & Johnson, and after about 18 months or so at the integration, I joined Lux Capital Management, and if you'll recall, what was it, 1 or 2 years ago? We had sponsored a SPAC together, so I will take no SPAC questions. Just totally kidding. Actually, it was a really great experience. I helped them as a venture partner, and at the same time also spun another robotics company out of Lux Capital Management, and so was doing double and triple duty for at least 2 years here. And these days, I probably focus about 5 to 10% of my time on investments, and then the other 100% of my time is on the startup. And so that's my background in a nutshell as well.
I love it. So let's chip away at that 5 to 10% that you focus on investments first. Start there, and then we can go maybe back to your other 100. And so Dennis and Josh, both wearing the operator hat for so long and having the success that you did, now working with a portfolio of entrepreneurs and founders and looking at emerging founders, emerging entrepreneurs and executives, I have to imagine you look at those operators with a bit of a different lens than, say, people who come from pure financial backgrounds, or maybe even some of the other people in your funds and partners that you work with. So talk a little bit about how your role as an operator has impacted the way that you interface with those entrepreneurs and executives, and maybe where your bar is dependent on the stage of company, the type of founder, all that good stuff. One of you has to start.
Okay, I guess I'm starting. Thank you, Josh. So I think it does bring a really unique perspective. If you've sat in the CEO chair, if you've run a venture-backed company before, I like to think, I don't know, I think one or two of my portfolio company CEOs might be out there. I'd like to think that I'm a little more empathetic to the plight and what our companies are trying to do. And for me at least, I try to be more of an assistant, more of an amplifier for our CEOs, kind of to help them go. And so I at least what I have found over the few years now that I've been doing this, when I'm partnered with the CEO of my portfolio company who's willing to partner back, it works really well because they're really open to the ideas. I mean, I learn things from them. I can help them kind of wade through various things. In the handful of occasions where they've not been willing to do that, when they're trying to kind of play their own games or their different dynamics, that tends to not work very well. I tend to have a lot less patience for that than maybe some of my partners as well. So I think it probably cuts both ways. For the most part, I like to think that it adds value. I don't sit there and try to do the jobs of my CEOs. I mean, I've done that before. I don't want that job, and so I try to help them any way I can.
Yeah, I think it's well said. This idea of like advising, coaching, and mentoring is sort of my first instinct, generally speaking. And then I'll kind of cut to the other side of Dennis's point, which is also like, I'm also, I would say, a lot less patient when people don't take that sort of advice to counsel and to heart. And so at the end of the day, my main objective is to help develop entrepreneurs, less so on the operating side, but I try to give them insights about like, hey, how is a venture group going to look at this? Like, what is your business? What type of venture groups should you be talking to? I'll do pitch rehearsal with them oftentimes. And that really for me is like the first litmus test, right? Because I, in no way, shape, or form, like, do I ever stiff arm an entrepreneur or an operator? I just try to provide guidance. And so whether or not that guidance is taken, even to 1 or 2 degrees, I think is my litmus test. And if it's not reciprocated, I kind of like, this is going to be really tough. And then also there's like a higher bar for quality, I think, as well. Like, I don't expect that a budding entrepreneur knows everything out of the gate. Of course, none of us do. But it's really like, how much effort do they put into the feedback that you provide? How much do they clean up the pitch? And we can get into all kinds of details thereafter.
Getting a board book done on time, right? Although, like,
just scheduling your board meetings, just schedule your board meetings for the year. Just schedule your board meeting. That's like the biggest piece of advice I can give you. And don't surprise your board members when you have the board meeting. If they don't know what the agenda, objectives, issues are at the company, like, I learned that from, I think, some of the best CEOs, is like, make sure that they are always prepared and that you are always prepared.
Well, and because I think part of the perspective you gain as an entrepreneur as you're kind of building companies and raising more and more complex financing, I think the role that you think of a CEO, or at least I know for me on my entrepreneurial journey, what I thought the CEO was earlier in my career was, hey, you're driving the company, you're pushing that, you're making a lot of different things happen, and it's you that's the driving force of that. And I think that's always the case. It's probably more so earlier in the company. As your company evolves, your role changes a lot as a CEO, and really your job almost becomes, you're kind of like the representative of the investors and the board within the company. So it kind of goes both ways. I mean, they're the conduit of information to the board and the investors driving that strategy on the top line. And then you're also reverse driving that back in. So what you decide as a board from a strategic perspective, the CEO is the one that's now deploying that within the organization. So it's a much more close-knit relationship, and young CEOs who can evolve into that and can build those trust. Now, it goes both ways. The investors have to be willing and have to be trustworthy as well. But when that happens, that's when you see companies performing really, really well. And when it's not, that's when you run into trouble.
You mentioned this idea that you're kind of the conduit of information and representation of the investor community to your company. And you talked a little bit about pitching the right investors and developing those proper relationships. Maybe for the operators in the room, now that you've been down that journey and are on this side, what are some of those finer points about managing a fund, being a venture partner, that you wish you knew or could convey to help people understand how you go about building those relationships and what it really means, how they run their businesses as VCs that could help operators be more successful?
Well, like a contemporary example, the number of decks and inbound requests we had for meetings, like as Silicon Valley Bank was melting down, was astonishing. So it's sort of this idea of context. I don't think I appreciated. I certainly did not appreciate until I went and spent time with the folks at Lux, just how busy they are. I mean, the amount of inbound that they get is astonishing. And so the first thing that I tell many entrepreneurs when they talk to me about wanting to raise, like oftentimes it's because I have like the Lux business card. They're like, we want to talk to such and such partner. And a lot of it is like, so much of it is context, right? And Dennis had alluded to, on the operational side, a CEO being able to go between levels. Like when you're running the company and it's like 5 to 10 people, you're running the company, you're driving the ship, and you're always driving direction. But once you become like a small village or a city, you're really providing context and prioritization, right? Whether it's for the team or for the investors, and you're hopefully connecting that. That same awareness, that same like context is super important when you go, if you're going to go talk to a Santè or you're going to talk to a Lux. It's not quite as simple as like what portfolio companies do they have on the page, and yeah, I'm a match, and here's why I'm a match. So there's some element of like, what kind of capital do they deploy? What is the environment that they're in? Did Dennis just announce like 2 or 3 other deals? Because if so, he's probably slammed. And so much of this is about timing. And so one of the other sort of thematic things that I counsel entrepreneurs on is like, you always want to raise money, I get it, and it's always a sense of urgency, but you really want to be in a position where you can afford yourself poise and pace. And it's easier said than done, right? But you want to make sure that you're not like, I've got to close this round in 30 days, because it's going to create frenetic behavior that is literally just going to like I think cause most investors to scatter, from my opinion. But
Yeah, I can't reinforce that more. I think it's a great point. I mean, one of the things I didn't appreciate was, I think a lot of us know the basic rules of when you approach a fund, have some context, understand, is it the right stage? Have they invested in other companies that kind of look like you? Not necessarily competitive, but like, do they invest in the types of deals that kind of looks like your deal? Like, those are some of the basics that I think a lot of people know. I never really appreciated the personal dynamic of when you're going into a fund. I mean, your comment about the amount of deal flow. I mean, at Santè, particularly as an early stage investor, I mean, and when times get tough, I mean, we get massive amounts of deal flow. And if I don't have context for that, or if I'm in the middle of another deal, like you pitch me, I've got a deal right now that I'm working on that I'm hoping to close in the next 3 to 4 weeks. I just don't have, like, you pitch me a new idea right now, I'm like, I'm cringing thinking about, like, I'm just trying to get this thing done. It's like, I can't even think about trying to get something else done. So this ability, you mentioned this word poise. I mean, I think having the ability to build some relationships with funds so that, like, when I'm coming up for air, in May and kind of thinking about, like, okay, looking around now, what do I want to do next? I kind of might already know because I may have met it at LSI or I may have met it, at JP Morgan in January. And not that we're slotting deals in like that, but like you kind of do because, like, when you pitch a fund, there is an individual or a couple of individuals that are going to have to do a ton of work. I mean, if they decide to move forward on that. And so we don't do that lightly because we're trying to be right on these things. And so I think just realizing that and, like, knowing that if you keep pushing, you're not getting the response, you're probably not resonating. Doesn't mean necessarily you're not a fit. It's just like they don't have bandwidth. Being able to gracefully step back and say, hey, you know what, want to kind of maintain a relationship, we'll check back in a few months. I just love that when I get that from an entrepreneur, and that kind of buys you a little bit of a credit to come back in down the road.
Not to make a bad pun since we have cocktails up here, but what would be the sober take on how long an entrepreneur or executive you'd say before you actually do that deal?
So the one I'm doing right now, we've been, I would say, working on it for almost 2 years. So, like, we met it was part of a thematic research. We got to know the company. We thought it was really interesting. We went up and visited. We didn't really align on deal terms. We kind of took a step back, and we did this dance for a couple of years, and they came back, and the timing was right, the deal was right, and we knew them, and the timing just worked out really well. And so, I mean, that's probably a little bit more on the extreme, but I mean, we're typically going to have known a deal at least 6 months, if not a year. And if not, we definitely know the space. So if you're coming to us with a new deal and in a space that you've not seen us invest in, that's harder too, because now I have to get really smart on the space and then get smart about your deal in the context of that, and that's going to take us longer as well.
yeah, and every partnership is different, but I would echo exactly what Dennis said. I mean, take these numbers as directionally correct, but not accurate, maybe 10, 15% of the time, particularly for like growth investments. Sometimes it's momentum, and it's a shorter cycle, but it's often when it's a syndicate or an investor with whom you've already co-invested a number of times, and they're sort of leading and you're coming along. Those can happen quickly. Those are great for the entrepreneur, of course, and great for the fund when that happens. But I would say seed, Series A, all of the early stuff, Dennis is absolutely right, 6, 12 plus months. Now, that's not to say that everybody has 6 to 12 months, but I can just tell you from like the internal like Slack channels that happen at the fund, the number of pop-ups I get on my laptop, like, hey, I met so-and-so this week, like no action right now, but they're making a lot of really great progress, and I really like so-and-so, right? And just that awareness, like those breadcrumbs that are left within the partnership actually make that partner's job. I'll caveat this by saying all funds are different, and all firms are different, but at least representing what I see from Lux is that a lot of it is like a group decision. So it's not just convincing Josh or Peter or somebody else on the team. It's like the whole firm has to feel really, really pretty good about it. So that consensus building takes time, and it's best done through relationships, frankly.
Right, so I mean, think about that. You've got to build a relationship with an individual partner or associate within a particular fund, get them excited, which takes time. We just talked about that could take several months to do it. And then let's say you get me excited about something. Now I have to go get the folks at Santè. I mean, we're a consensus organization. I need to kind of get their buy-in, and I can't just show up one day and throw a pitch in there with no context and expect that that's going to go well. So there's a lot of kind of planting seeds, and the ability to kind of watch a company track along and show that they make progress helps that a lot.
So a couple days, about a week ago, you're getting a bunch of Slack pings that somebody you likes this person, maybe met this person. Take a sip. We're going to talk about it. You're in the middle of some research. You're working to close a deal. and you see the first tweet that something might be going on with Silicon Valley Bank.
I mean, none of us on the wheel of fortune of stuff that happens in venture startup world, no one had global banking crisis on their bingo card. I think it was just, it caught all of us off guard. I mean, I think it was just, how quickly things moved from really Wednesday to Thursday night, when my phone started blowing up on Thursday night, syndicate partners and CEOs calling. And, mind you, the Twitter war has already been going on all day long. And I mean, I'm very happy to talk about the advice we gave. I mean, we had, I would say, at least half of our portfolio in Silicon Valley Bank. Our fund, banks with Silicon Valley Bank, they've been a great partner. They're there for a reason. We looked at where they were and where deposits were and kind of the health of the bank, maybe not from a shareholder perspective, but from a deposit perspective. We're like, I mean, they're solvent. Their bonds are undervalued. They have to hold them. So we kind of recommended, let's hold tight and see how it goes. And completely underestimated the bank run concept. And I had actually a really interesting conversation with a syndicate partner on a deal where we were kind of giving competing advice on that. And Friday they were like, look, that was a mistake. We couldn't have done anything anyway because you couldn't, if you were Thursday afternoon, it was too late. And then so the announcement comes 4 p.m. on Sunday that they're getting backstopped. And I tweeted, so I wake up Monday morning, SVB is the safest bank in America. So it's like, that's how quickly things changed. And it was a frightening time.
I mean, I don't have a lot to add other than my personal experience was that my finance person texted me quite literally, and my iMessage is like, whoop. It's like, money out of SVB, yeah, question mark. And I went, whoop, did we get hacked? Whoop, no, whoop, what's going on? Bank's failing. Okay. So, I mean, it's one of those things, like you're in the middle of an interview, number one. And again, because I sit adjacent to Lux, was riding shotgun with them. They're like, and credit to them as a firm, and I'm sure that many other venture firms did the same. It was like, okay, if we have a liquidity issue, we don't think that the Fed is going to let this go belly up. Worst case scenario, we've got a liquidity issue. Like, we will set up a fund to deal with payroll. And so, you start to think about the health and solvency of all the people that are employed in your portfolio. And it's just, you go into how do we manage this crisis as effectively as possible. And yeah, as Dennis said, it's not one of the things that you plan for on a Thursday afternoon, right? It's a fun weekend, though. A lot of action on Twitter. That weekend.
And look, I mean, I think everyone's trying to figure out, well, what is good treasury policy? It's like, what are we going to do? You give a company $5 million, you can split it between 25 different banks to hit $250K. I mean, every bank account you add is exponential increase in fraud risk. So it's like so and two, like if everybody had 2 bank accounts on Thursday, that thing would have collapsed in seconds. So I think we're all trying to take a step back and say, okay, what is good policy? What is the government going to do to kind of prevent some of this stuff as well? Which I kind of hate saying that as a kind of a libertarian type, but really, there's just not a good way to hedge that type of systemic risk. Back in 2008, 2009, I mean, I think we kind of all saw it coming, right? And so you could kind of plan for a little bit, but here this was just, again, just not what we planned for.
So you talk about an external market force or condition that you maybe didn't have on the board, but Scott talked about a panel that you did a while ago at LSI. I want to maybe revisit a panel that you did at LSI a while ago, that when we think about things in the external marketplace that were impacting investor behavior, company behavior, talk about kind of the SPAC ecosystem and what was going on a couple years ago when it was seemingly really exciting and new and we were all talking about it and it looked to be something big, and then where we are now, kind of comment maybe on the evolution over the past few years and from your perspective having run one.
Yeah, I mean, I think there's still merit to that instrument. I would say when we formed ours and when you saw the bolus of other special purpose acquisition corporations being formed in let's call it late 19, probably more so second half of 2020, we were sitting amidst, maybe, was it 8 years, 7 years from the 2012 cycle. So we were sitting at the tail end of an extreme bull market, very aggressive monetary policy, and I would say asset prices, whether it's like a painting, a luxury watch, a vintage car, a Silicon Valley startup, they were all inflated. I mean, I think that they were all really high. And so you had, at least in my view, this private market where there were valuations that were extraordinarily high. I think the IPO market was open then, but it was different flavors of companies going through different pathways. Our view was then, and we still maintain, that the SPAC is a reasonable outlet for some companies. Having said that, the macroeconomic forces that came to play, what you've seen play out with many of the SPACs, like many of them didn't end up well. I think maybe you can count on one hand those that are still trading, at near within 20% of their $10 price. And so for us, we did structure ours with, I think, some financial discipline. You put the money into the promote, and then we have what's called a forward purchase agreement, which essentially said we were going to put some multiple, like 3 times the amount of money into the investment in the company after the combination. And that discipline was a really good governor for us, like that feature of our SPAC. And so we ultimately got close to transacting. It was one of these situations where the company wanted capital, but it was a development stage biotech company. We were successful in raising part of the funds that they wanted, but given that environment, it was like, well, why would we transact? Because you're just going to go do a secondary in a market in a distressed environment. It didn't make sense. And so what I still like about that product, if you will, is the ability to build an investor syndicate in the public market. I think that is really strong, but it is not something to be taken lightly. In other words, quality matters, whatever that you do. So whether it's on the private side or the public side, like you've got to have sound fundamentals in place. And I think, unfortunately, too many companies got through that didn't have those, and the results speak for themselves.
Yeah, I mean, I think we were looking at it. We didn't have a SPAC, but we were obviously watching that, and
You should start one.
we can start, yeah. And Santè, we do a reasonable amount of biotech investment as well, and you were seeing a lot of activity on the biotech side, and obviously a lot more IPO activity on the biotech side. And so we were getting a lot of our CEOs on the biotech side seeing this as an alternative financing vehicle and pursuing that. Maybe a company that was having, maybe their stage wasn't quite right, and they're trying to raise money more traditionally, struggling a little bit with that, not quite an IPO candidate, thinking that a SPAC might be a way. And there was this dance I remember, and it was probably you guys were on the other side of this, where the SPAC companies were starting to realize their clocks are ticking a little bit. You've got companies as the market's starting to tighten up that are like, oh gosh, we better finance, figure out what to do. And there was a lot of time, a lot of churn, I think, wasted on both sides of companies, spending time thinking that the SPAC would be a good vehicle for them to go, only to realize that, okay, it's a great vehicle, but you still have to go out and raise money. And again, your structure was the discipline is interesting because kind of forced maybe a higher bar on that, which would increase the chance of a success of the pipe that goes. But a lot of these weren't. And we found out the hard way. We had one company that signed into a deal and then went and did a pipe, and we learned it was just literally the same funding process that we just went through. And if you couldn't do it independently, you weren't going to be able to do it as a SPAC. And I don't know, and then it just really quickly unraveled after that. I mean, we did talk that when there were so many being created that we all knew we were in a bubble, and that was the sign to us. And you never know when it's going to really go, but we thought this is peak SPAC. This is probably the peak of the bubble. So.
Well, gentlemen, thank you both for answering all of my questions. I want to make sure that, I think I've got plenty of mine out. I want to make sure that everyone in the audience who has questions has a chance to ask them. I think I hopefully speak for you guys when I say they'll probably answer anything, but you may not like their answers. I can't promise that. But thank you very much. And we have a microphone circulating, so if you have a question, raise your hand, and Amber will bring it around.
You guys both do biotech and medtech. Lux also does some deep tech and other areas, right? How do you kind of think about the risk reward when you look at some of these different areas that are definitely not an apples to apples kind of comparison, and you have a portfolio that can go after these different sectors? How do you kind of think about where you decide to put your investments within a given portfolio?
Yeah, no, we talk about this a lot. I mean, as part of our strategy that we pitched to our limited partners, biotech, we kind of like to say, has a lot of alpha. I mean, you can make an investment in a biotech company, and market size, I don't want to say is irrelevant, but is never really, really the issue. It's a lot of technical risk, it's a lot of clinical risk, but if you're right, it's pretty easy to paint a picture for $1 billion exit. I mean, it's really hard to do $1 billion exit in medtech. I mean, you did one. I mean, there's a handful of them where that happens, and Oris is probably the only one that did it pre-revenue, right? And so, on the medtech side, we see that, maybe a little bit less alpha, less ability to go drive that, multi-billion-dollar exit for an early stage investor. But what we like about medtech, it tends not to slosh around as much as biotech's either on or not. medtech, I mean, I'm sorry. I mean, I've done medtech almost my entire career. It's always hard. Sometimes it's a little less hard. Sometimes it's a little harder, but it's always kind of hard. But there's a lot more discipline in the medtech market and the medtech ecosystem. And we like that as an event. So I don't want to say it's a safe harbor for us. We kind of always keep the medtech stuff going, but valuations never get too high. IPOs, yes, come and can drive a little bit of alpha in what you're doing. And then health tech's, kind of in between. Health tech, I think we're all trying to learn what that business is really like, and really how do you drive real cash value back. I mean, there were a lot of really good paper gains in some of the health tech stuff that happened over the past 3 or 4 years. But in terms of actual cash back to funds that they can distribute to their LPs, that's still out there a little bit. But the ability to be able to hit real milestones on a smaller amount of capital is unique to health tech compared to both medtech and especially compared to biotech.
Yeah, I think that's well put. And so Lux is a generalist fund. I focus exclusively on healthcare when I do help the fund. And so it's often to my chagrin that I have to compare any potential investments, less so on the biotech, but like health tech, life science tools and instruments, med tech, to a deep tech company, or even we don't do traditional SaaS, but things that make a big difference. And so our criteria is really the same across the board. I mean, I can give you the whole, we aim to get 10x, but we do aim to have significant returns for our investors by backing, generational founders, generational companies, right? That's our view. As Dennis said, unfortunately, medtech is just more capital intensive. And so the kinds of medtech companies that we look at, as it pertains to this audience more so, are those bets that generally are a little bit bigger. We won't necessarily look at something that is a tuck-in acquisition. I think those are perfectly acceptable opportunities. I think they address unmet needs, help patients, are good for strategics, but it's just not necessarily what Lux is going to do. Because if you look back at all of the data, the capital in versus the returns is not quite the same multiple that meets our hurdle rate. And so a lot of it is just juxtaposition of those different opportunities and which ones give us the biggest bet. So, we are pro med tech, having said that, but it is largely things that look a little bit more Orus in nature. So a lot more robotics, usually multidisciplinary research and development, and then it sits at the intersection of disciplines, either on the commercial side or clinical side.
And Henry, it kind of goes back to your, some of your original comments on how, when you think about a venture fund, there's, okay, do they invest in my space? Do they invest in my stage? Also, lots of venture funds have multiple different philosophies of how they'll look at a particular space. So you take medtech, for example. Yes, it's capital intensive. It's harder to scale. There's almost like you kind of see a dumbbell of strategies between venture groups. I mean, Santè, we're early. Early works if you can get an exit reasonably early for the amount of capital that we're deploying. So we tend to, frankly, do more PMA stuff, so things that are going to trade on data, where first in human study evaluation is a real value driver. There's a timeline to pivotal, and somebody's buying the company on hope, not on a revenue multiple. That works for us as early stage investors. There's a whole nother group of medtech investors who are on the opposite end of that dumbbell, where they're like, look, we want to be on the other side of that risk. We want to have very predictable abilities to understand the scientific and the regulatory risk on that. But they're deploying lot larger amounts of capital, because what they're driving for is getting something from a couple $1 million in revenue to 10 to 20, and then getting a revenue multiple on that. But they've deployed a lot more capital. And so again, there's different ways that people think about parsing that, and we don't put that on our websites and stuff. But if you talk to funds, you'll learn that about them. And again, that doesn't mean that your business model is wrong for you. There's like tons of great business models out there in medtech that aren't good venture investments for a Santè. But it's just, you got to be cognizant of that. And when we give you that feedback, I mean, it's real. It's just how we've learned how to make money.
Yeah, I think that's a great point. Even less so than the PMA or non-PMA side of things, betting on data versus betting on commercialization. I would say the number one reason that something is a mismatch, even if by profile, by qualitative attributes, I'm a robotics company or whatever it is that looks like something Lux has done, I would say 90% of the no's in the healthcare space that come from the fund are because they're strategic mismatches. And so our bell curve is like big investment in seed Series A, very little except for follow-on participation in B and C, or growth. So like we won't do anything in the middle. So I see dozens of incredibly attractive companies that are like A, maybe going into their B where they're still pushing through a pretty significant development path. And by that point, it's usually a valuation and a return calculation that just says, hey, this is an incredible business. It's just not for us.
And ironically, you and I were both at companies that had to go through that stage, through that you think about EGS and like,
I was going to name it.
Oh, yeah. Apollo, I mean, you can look at at Apollo, we hit that, like we got our products approved, we're doing a couple million in revenue, and we were thinking like, how do we scale to 20, 30 million? And no one wants to invest in that risk because you don't get paid for it as an investor. So
it's going to be another round over the top.
Yeah, I mean, we had to get creative in how we're going to do it. And we ended up acquiring, actually, using debt, we bought a sales organization out of Allergan, effectively is what we did. That's how we solved it. I wouldn't recommend doing that. Like it was actually really hard. But again, it's like you have to get really scrappy as it relates to that. So, and you look at like a Shockwave, so these other that's Inari that sail right through that. But those are companies that probably had 95% gross margins out of the gate, and so you got to think about your business as well too. Like, do you have the ability to scale revenue and build margin? Because if not, it's going to be hard.
Yeah, that's the other thing too. Go back to a point that we mentioned earlier. The relationship piece is really key here because if you are like, let's say for Lux Capital, you're in that sort of no man, no person's land between seed A and your C or D that's like true growth. Having that relationship is key because they are such wonderful networkers, and I know that many other venture firms are, but if you have like an authentic relationship, like they will find someone who will fill the middle for you. I'm not going to suggest that it's easy, but like having those relationships that are really meaningful is going to make fundraising so much easier. And so I talk to many CEOs and their common refrain is like, I'm always fundraising. I always feel like I'm fundraising. It's like, sure, but like you should actually not look at it as like the transactional side, give me a term sheet and let's get the docs going. Like that's the wrong way to look at it. I think you definitely need to look at it as like bridge building and developing meaningful relationships. And I think all too often I've been guilty of that as an operator.
Any other questions?
Oh no, Scott's got one. The ringer.
All right. You guys both have a reputation for being really nice guys. I want to know. I want to know some backstories here. We'll go to Dennis. We'll pick on Dennis. Josh, when have you seen him? What does it take to get him upset?
So Dennis and I were.
We got cocktails flowing.
No. Like, I mean, I have to go back to 2009. I was like a wee lad, and Dennis was at Apollo Endosurgery. We're going to be talking about natural orifice transendoluminal surgery all night here. So Dennis was at Apollo, and I was at a company called Endogastric Solutions. So we were effectively competitors. And I think one time they like SAGES, which is the surgical gastrointestinal endoscopy conference. Like they put us right across from one another. And I'm like 27. I think I was just staring Dennis down. He's wearing cowboy boots, and I decided as I looked him up now, I'm like, I think he could probably beat me up. So, but I don't remember Dennis ever, frankly, getting hot about.
I do. I mean, I get.
Not with me. So I don't have a war story for you other than being terrified of him.
I do get. I mean, things that make Dennis mad. Yeah. I mean, I didn't know we were going to go there.
I don't want to make this a negative end to the thing here. I want some backstories. How about some near-death experience? We talked about near-death experiences.
Oh, I can tell a near-death experience.
Near-death experience is something we should learn from that.
So back in this point when I mentioned this is like 08, 09, which we like lots of us have scar tissue from 08, 09 when the markets collapse and no venture fund has money. They're not going to raise money. And we're just hopping around, happy entrepreneurs raising money for our company, thinking everything's going to be okay, and not realizing what we were walking into in this desert. And so as we kept going, and you enter this thing. Everyone know what bridge world is, where you're just bridging. I think we did like 11 bridge financings in a row. 11. Like literally, it was just like, I've got a bridge, like I didn't even have to call the attorneys. I would just edit the Word document myself and send it out.
Just change the date.
Change the date on it. And that was super painful. And so we had applied for a grant. The state of Texas had some, and still does have some actually really interesting incentive grants. And so we had applied for this one, and we really thought we were going to get it. And I'll never forget, I was in Cleveland, Ohio, doing a lab because we thought Boston Scientific was going to buy us. They did just 12 years later. And so we were doing this lab, and it was snowing in Cleveland. And I don't want to offend anybody from Cleveland, but like downtown Cleveland in the hotel when it's snowing and like you're stressed. And I'm waiting for the phone call from this government office that's going to give us this $3 million. That's literally going to save our asses. And the guy doesn't call, and it's just like, it's 3:30. And I call him and finally get him on the phone. He's like, yeah, Dennis, bad news. Like, we turned you down. And I'm just like, oh my God. And I'm just like, call my CFO, and she's already started drinking. And I remember looking out the window and like, I'm like, just, Dennis is staring out the window, pondering what he's going to do. And it's like, there's a rooftop of the building below about 10. I said, if I jumped, and it was just this barren landscape. And and I had spent the night in Cleveland, went back, and we scrapped through. We found a way to pull through it. But man, you have to dig deep in times to do that. I mean, we had so many near-death experiences at Apollo, and I remember another time, I had a separate American Express credit card that I used so I could figure out what was an Apollo expense and what not. Everybody's doing that when you're early. My wife calls me one day. She's like, "Why does American Express say we owe them $140,000?" Like, because at the end of the day, it's your credit. And I'm like, "Well, no, it's just a mistake. Apollo's going to pay for that." And we had like $40,000 in the bank. So it's like, these are the stories that you guys all live through. And it doesn't always work out, but if you persevere long enough, it can. I don't have any job. I mean, look, the guy's always smiling. He's always dressed super nice. Like,
I mean, do you want me to do the anger thing or the near-death experience thing?
Take your pick.
Yeah. I mean, near-death experiences, right? So I think including the SPAC, right, that was a big sum of money. I think I've helped across like 4 companies probably raise north of $750 million, and none of it was easy. All this is in the public record, so I don't think I'm sharing any confidential information, but I'll just name these, I'll number the companies rather than name them. My second startup, we were trying to raise funds. I think it was like our Series D. We were really getting close. We have a term sheet, and then we got hit with like a key TAM lawsuit. Like, this is gonna go well, right? And it had to do with claims about billing and reimbursement and how the company went about, guiding physicians to do that. And it was just, it's not the same thing as SVB melting down, but these are like, you're putting all of your blood, sweat, and tears into fundraising, and then you get hit with something like that, right? I think, even in the endogastric solutions days, there was I'll name Oris, company two. Even in the more contemporary experience, we had an IP matter that came up during fundraising, right? It's just like, well, hang on, we've done, FTO, and we feel good about our IP, and then you get a lawsuit that comes out. So a lot of times it's the exogenous things, the things that are unrelated to your business that like honestly will get you to lose your cool, right? Because you have somebody, you've built the relationships, you feel like the relationships are there, you got the term sheet, you're maybe even at definitive docs, and like things happen. And I, there have definitely been times, I don't know if Henry's seen it, but I've gotten hot as an operator at a company, and it actually doesn't almost ever pay to do that with investors. And it's not just because they hold the power, it's just like it can so damage the relationship. And so I think I've learned over time, you don't send inflammatory emails. I used to do that in my 20s. So any of you who still do that, stop.
Read it, set it aside, read it in the morning.
Send it to yourself, maybe send it to your significant other and see how they feel about you. Like inflammatory emails, text, like that stuff is just not helpful. I mean, we all have some inclination to do it, but like I've learned those lessons. With Scott send bad emails or? Yeah. No, I mean, and it happens. It gets the best of us, all the time. So I think it's what I said earlier. It's like poise. Like I think you got to just take it, not to be too zen or meditative on anybody, but like to the extent that you can take a breath. Dennis said it earlier. Running med tech companies is hard. Investing in med tech companies is hard. At the end of the day, we're all doing this because we believe in the ability to like help people through our innovations. And I think you got to like really try to center on that, even when you're getting completely shelled by the outside world.
We used to talk about how do you manage the stress of doing these startups through all this type of stuff? And we used to say you got to learn how to stare into the abyss. I know that sounds terrible, but you have to. And like, I remember sitting there thinking through, Apollo during these days when it was just not looking great. And like, you really just kind of, play the chess match. Okay, well, if we don't raise money, what happens? And how do we take care of the people? How do we do those types of things? And then like, you never want to do that, but somehow emotionally thinking through that and just understanding like, look, these people will get jobs. You'll help them do that. You'll get them through that. You can come to a peace on that. So you don't feel so fatalistic that, if it doesn't work, that your life is over, because it's not. I mean, there's so many great success stories of entrepreneurs who had a deal fail and they wound it down very professionally. Investors really, really appreciate that. And then just because you fail doesn't mean they won't invest in you again. And so I think just keeping through that, and again, you said again, Josh, this idea of poise. I think it's just such an important way to think about it in terms of how we do this and how we lead our teams, and how we represent our companies to the outside world.
I think if I could ask just one follow-up to that. So I talk to a lot of younger entrepreneurs, right? You talk about the crop whose first jobs were at Oris. A lot of those people will start companies, and they saw a very different world, obviously, but a lot of those people will go on to start companies. And I think some conversations that we've had is, hey, we know we get one call to Josh DeFonzo, right? But if it doesn't go well, a lot of people I think are worried about that first startup not going well. I think we haven't really talked a lot about what do you do in that case when you have that need to wind down, or if you're worried about that reputation. Is that risk, is that really that high? Is it something that you have been through where you've seen entrepreneurs that have wound something down and go back to those same investors with success and preserve that relationship and that reputation in the broader market?
My personal viewpoint on that, like my own experience, I would not suggest that my first two startups were failures, but they were not resounding success. And frankly, the way I found myself at Oris, I had been described more than once as a battlefield upgrade. What does that mean? Well, I started at my first like actual operating role. I began in sales, and I was motivated to go into product management and subsequently executive management because I was selling bad products. I was a distributor, and it wasn't to say that they were bad, they didn't work, but you call customer service, nobody picks up the phone. You have a recall, nobody communicates. Product managers are in meetings all the time, they can't help you. And I just went like, this is not the right way to run a company. And so in a stroke of naivete, I said, I'm gonna go make products. And so my first two companies weren't great. I was a product manager, and at one of them, I went from product manager to interim president in like 7 years. And I had this massive sense of imposter syndrome. And I stepped back from that, set up a consulting business, which is kind of what led me to Oris and working with other companies. But I would say, you're not always going to succeed. I mean, it's all about like how you conduct yourself and handle yourself in the face of failure. Now, if you lose Dennis's money, is he going to invest in you again? Probably not. But no, I'm just no. But I think it's how you conduct yourself. I think oftentimes now, as far as that is actually concerned, like losing money from one investor, I think if it's like technology risk that you just couldn't control, I think that's one thing. I think it's like if you get the technology through the gate and you have a complete market mismatch, like that's depending upon your background and pedigree. Me as the commercially oriented operator, like that's a big no-no, right? I don't know that I would never work again, but I think it would be more of an uphill battle. Suffice it to say, my message is that like you have to be, when you get into the startup game, you have to understand that failure could happen, and then you have to do everything you can to sort of acquit and like reduce risk along the way. That's kind of how I look at it. Like I think if you have the unbridled enthusiasm, this is never going to fail. Like I don't ascribe to that. I know that there are certain CEOs who do that, but I think your blinders are way too narrow, and I think that your like residual risk is way too high if you conduct yourself that way. So, and I think the investors know that. I mean, you don't.
No, that totally resonates with what you just said in terms of, there's almost like a self-awareness that you kind of look for as, being able to embrace the fact that you understand why your company failed or why your technology failed, be able to talk about that, how you maybe acted before that when, maybe we didn't invest in it and we kind of told you that, and your reaction to that we'll probably remember. But again, we have lots of examples of CEOs that we invested in. Something didn't work out. A lot of times it is kind of existential risk that no one really could have seen, and we've invested in them and backed them in companies down the road. So I just think it's again, you're looking for that leadership. You're looking for the person who kind of thinks. Can look externally at themselves, at their company, and be honest about that while they're in it, and then maybe in the postmortem as well. And so, look, I mean, you sometimes you get into things, especially as young entrepreneurs. Like, there's always this challenge of you just want to be a CEO and start a company, so you jump in and you start something and you didn't really know maybe, and you're in there now like, oh crap, like I wish I would have known like how hard this was going to be, or you hear that a ton from young entrepreneurs as they go. You're going to get a buy on that. Like, take your lessons, learn that, manage your investor dollars, reasonably, respectfully on that, maintain good references with investors, and you'll get another go at that for sure.
Yeah, I mean, final comment I would add to that as well is like this, I keep saying it, it's like this idea of the relationship. It's the idea of like being prepared as operators, right? Like, as an example, every company with which I've had the pleasure and stress, frankly, of operating with the board and the investors is like, you have to set expectations, right? So even today, like I go into every board meeting, highlights, here are the things I'm concerned about. Let's go through them. I make sure everyone's really aware, and none of those are like planting the seeds for later excuse. I don't ever view them that way. I view them as like, I need to make you aware of the risk that we're getting into, and here's what I'm going to do to manage them. It's never like, I told you for 4 board meetings that risk was going to come up, and shucks, it did. Like, it can't be that, right? Like, it can't. And I see that orientation on occasion as well. So I think a lot of this is just, it's really how you conduct yourself, and I think it's this idea of, intellectual honesty, you're like really maintaining relationships, and then working your butt off. At the end of the day, that's what you expect from everybody. We can talk about balance and all that philosophy, but you got to try your best. These things are not easy. So they're not 40-hour-a-week jobs. They're not even 5 days a week most times. So it's just like, it's how you conduct yourself, and I think you said it, adapt and learn.
Any other questions? We can do one more on stage, and then I know they'll be around.
Yeah, so yesterday, on one of the panels, one of the moderators really was adamant about sounding the alarm on capital drying up, and he was claiming that all the VCs were going to start holding capital in reserves just to focus on existing portfolio companies and getting them through the next 18 to 24 months. You guys agree with that?
I just said we're closing a new deal, first investment in, hopefully in the next 4 weeks. I mean, we're deploying capital. I mean, I say we're being patient in the investments that we're making. We're being cognizant of the market. We're probably thinking more about maybe not necessarily the round we're doing there, but will things clean up and clear up when we have to go out and raise again? If we can kind of get ourselves confidence on that, both from a company operating perspective and from a market perspective, we will still, we are still deploying capital. I mean, it's pretty easy to figure out who's deploying capital or not. I mean, you can, if a fund, is, they've got 14, 15 investments in the current fund they're deploying out of, they probably don't have many investments less, and you're going to see them slowing down. If a company has just announced raising a new fund, maybe they got a fund in right before, the world started moving down last year. They're deploying capital. So, I think, like, look, if I'm a tech investor, like right now, like you are hearing, tech investors and some of those funds who were basically just, ignoring valuations, ignoring market fundamentals, who their LPs are telling them, please don't call capital. I mean, you are hearing stories about that, but in healthcare, we are not hearing that in healthcare. Now, does that, are we in a tightening, more risk-off phase? Yes, we are. I mean, we all know that we're all feeling that, but this is not 08, 09. Like 08, 09, like for those that lived in it, was just fundamentally different. And, there was really no end in sight as to what was going to kind of repair the markets in a way that you could see venture kind of coming back. I mean, here, I think we feel like, yes, things are going to be tight, probably tight through this year, but that, next year, as, really what you're looking for is, these limited partners that are out there who have allocations to invest in private equity, like they just got to see that those public valuations go back up so that balances their portfolio so they can deploy in the private, so I think it's just time to be a little bit smarter. We're not where we were, 12, 24 months ago, but we're not where we were, 12 years ago.
Yeah, I mean, there's not bags of cash being fired out of T-shirt cannons like there was a couple of years ago. But I would say, like sentiment drives behavior, right? The SVB thing, somebody yells fire in a theater, there's not a fire, but people get up and run out. And so I think I wouldn't totally discredit what you're hearing from other people, but I much more so agree with Dennis. I think at the end of the day, investment firms, it's their job to deploy capital. The bar has been raised, right? The environment's requiring us to make sure that we are like even more judicious than maybe as a community we were 2 years ago. But I think, as my father says, cream rises to the top, right? And so repeating myself, it's like I think poise and persistence really matter here. That doesn't mean to be ignorant and say, well, one investor said that they're not going to invest. But I do think you've got to stay at it. I think you got to realize that since the bar has been raised, the same sort of counsel and advice we've been giving is like the relationship really matters. Taking the time to shore up your business case, to shore up your use of proceeds, like to do the things you can do to really button up the investment. And the other thing I would say to entrepreneurs, nobody wants to hear this. Like I think if you did raise in 2019, 2020, and you got like a handsome valuation, I think it's time to like look deep in the mirror and ask yourselves like, where am I today? And is the capital that I'm going to raise really help me get this to where it needs to be? Because I often hear, and I say this as an owner of a startup company, like, I think you just need to be valuation sensible at this point in time. That'll help get it there.
Well, since this is our last one, I do want to end with one more question. We're over a little time, but when we have this conversation again next year, LSI USA 24, and people in the audience come and find you guys catching up at the bar, what will you guys be talking about then? Whether it's technology development, market spaces that are interesting and exciting, what you think the investment climate will look like then compared to today. What do you think will be the big topics of discussion at this event a year from now?
That's a hard question, Henry.
Give us your top 5 stock picks.
Yeah.
Can't use ChatGPT to write bullets for this one. Sorry.
Well, yeah, we won't be chatting. We'll have our GPT avatars speaking for us, which is actually a super exciting space. I mean, I think it's funny that in such a really, and we shouldn't go down the tangent, but in such a really tough market, those companies are getting amazing amounts of funding. I mean, it's truly transformative technology, and so that will be fun to watch. Look, I think this time next year, we'll be in March. I think we'll be seeing hopefully signs of the public markets opening back up. You'll see it first happen in the biotech space, because they're always a little bit of the canary on those things, and you'll start to see maybe a couple of medtech companies who got good, sound businesses going public, and hopefully a fairly robust M&A market starting to go. I mean, look, the large companies right now are on the medtech side they're having tighter times themselves, and so that's impacting M&A a little bit. I think everybody's kind of hoping that as inflation gets back under control, money policy starts opening up a little bit, that 2024 is going to be, I'm not going to say like a banner crazy year, but I think we'll all be feeling better, and funds, you'll see venture funds raising and closing their next funds, and I tend to be an optimist. I think you have to if you're going to be an entrepreneur, but that's where I hope we'll be.
Yeah, I was going to express it as hope as well. I think I'm hopeful that the macroeconomic conditions will improve. I echo Dennis's sentiment. Like, I think that med tech gets a little less affected. Like, when the markets were really frothy, I don't know how all of you feel, but like, people weren't exactly excited when I came and pitched them about like another medical device, right? They're like, oh boy. So I actually do think this is an opportunity to shine. Like, honestly, as crazy as that sounds, and you are going to hear the same comments that you heard, like, powder's dry, but the fact is there's a lot of dry powder out there. So I think people are just being very judicious about deploying it, but this is your opportunity to shine, right? Because I think every single one of you likely has a really good business case. The question is whether or not you can find the investor who sees that the capital invested to get to the other side is worth it, and I think that those folks are out there. So I think, I do think that medtech does cut through the noise, particularly in tougher times, and so I would leave you with that it's a real opportunity in the next 12 months, and hopefully everybody in the room comes back next year and is well-funded, and we are high-fiving, and we're all making progress on our innovations, frankly.
Amen. Well, guys, thank you so much for doing this. Thank you, everybody, for this for joining us for this one. And I hope you all enjoyed the panels, the content at this event. Round of applause for the panelists and for everybody who was on stage at this event.